Hi, good afternoon, everyone. Welcome to this virtual roundtable on sustainable private debt. Now let's get started. I'm really excited to have with me 4 experts on the topic of sustainable private debt. So let me begin by introducing our first panelist, Cecilia Schult. Cecilia, you're based here in Stockholm and you have worked as a portfolio manager at Skandia Life Insurance since 2013. You select external managers, mainly in the private debt and direct lending space. Can you tell us how you work in selecting private debt managers and to what extent ESG is an important factor for you?
Yes, absolutely. So my name is Cecilia Schult, and I'm a portfolio manager at Skandia, as Selina said, and we all work across actually all different types of fixed income asset classes. So it includes liquid as well. But first of all, thank you for inviting me for today's discussion. Happy to be here. So we have invested in private debt for a long time, but really picking up in terms of resources and capital deployed since after the financial crisis, when we saw a good risk return opportunity. And today we hold a combination of private debt investments through external funds and also through direct investments. It's still a relatively small part of Skandia Life's total portfolio, but it's growing, I would say. And private debt, I mean, as you all know, that's really an asset class that's composed of many different types of strategies. And our main allocation is to leverage loans, but also includes subordinated debt strategies and direct lending, and everything with a European focus. And to today's topic, Skandia's goal includes sustainable investing to contribute to solutions to global sustainability challenges. And this must be done whilst providing good returns for customers and owners. But with adequate risk taking. So to combine all this, we do think that having ESG related considerations should provide a material input to investment decisions, and that the integration of ESG that supports our commitment to sustainable value creation really in the long term. And we are continuously obviously developing how we integrate sustainability aspects in our operations and offerings. And for example, at the end of last year, we launched a very ambitious climate transition roadmap that greatly increases our pace of climate adoption. And this would impact all our investments, including private debt, of course. So I would say that ESG is definitely an important factor in how we allocate capital. So it's really on the top of our agenda.
Thank you, Cecilia. Our second panelist today is Laura Vaughan. She's head of direct lending at Federated Hermes. Laura, you joined Federated Hermes in November 2015 when the private debt platform was being established, and your role has developed from analyzing potential fund investments to now also include managing the direct lending team. Can you tell us in broad terms what ESG integration means to you?
Sure. Afternoon, everybody. I think my view of ESG integration comes from my current employer, Federated Hermes. Possibly, I wasn't overly aware of ESG before I joined the firm. And I think I was lucky enough to fall into one where ESG, responsible investment and stewardship, forms the backbone of Federated Hermes and has done since it was established in the early 80s. All of our funds consider ESG throughout them, and that's no different for the direct lending funds. And I think for me, what ESG integration means is that the consideration of ESG risks is threaded through the entire process, from when a loan is originated, which might be what sectors does the portfolio manager exclude, what are the minimum hurdles that a borrower would have to have in terms of ESG characteristics to get over, through the investment process. How are they assessing ESG risks? Where are they sourcing their information from? What questions are they asking? And then after they've made a loan, how are they continuing to monitor the ESG risks? Do they have sufficient resource in the team or in-house to engage on ESG issues? So it's something that ESG just doesn't stop once you make the loan. It's something that's integrated from day one all the way through until the day you get repaid.
Thank you, Laura. Our third panelist today is Thomas Lane, fund manager at M&G Investments. Thomas, you joined M&G Investments as part of the graduate scheme in 2013 and you enjoyed a rotation across a range of teams before becoming a permanent member of the leveraged finance team in 2014. Can you tell us a little bit how much and how your team integrates ESG?
Thank you, Eileen, and good afternoon all. At M&G, I think we really recognise that we're on something of an ESG journey, both as an asset manager and also as an asset owner. So ESG continues to mean different things, and that's certainly true across our diverse asset management client base. As I say it today, the views range from financial only objectives and people really at the start of their ESG journey, all the way through to our impact financing fund and our newly formed Catalyst team, who are aiming to invest £5 billion worth of our own capital as an asset owner in private impact and sustainable investments over the next 5 years. And week by week, it really seems that clients are moving up the spectrum and the range of views are narrowing from the bottom up. So moving away from financial only objectives through to a more ESG integrated and sustainable approach across the board. In terms of the final destination, I think it's my own view that as a society, we've probably got quite a big, significant problem to solve in that how we use the planet's finite resources more sustainably, i.e. how we shift the economic models from a linear take, make and dispose models to a more circular reduce, reuse, recycle. And that's an enormously complex task, and to achieve it really requires a fundamental shift in organizations' decision-making processes and logic. And it's that decision-making process and its deliverables that we as investors need to be monitoring and also helping companies to evolve as well. So diversity inclusion data, for instance, is one of the many indicators that we're looking at quite closely as a proxy for diversity of thought in that decision-making process and throughout an organization. So as a gold standard bottom-up approach to ESG integration at M&G, we've got quite a comprehensive ESG scorecard against which we're assessing all companies' starting points today and their stated plans and targets for improvements going forward. And then we'll use this information, or are using this information, to prioritize really meaningful ESG engagements. And that's where we have very clear stated objectives ahead of those engagement exercises against which we'll monitor company improvements over the time. Now, once you've done that analysis and gathered the information, it's then a question of what you do with it and how you apply it. And that's really where the spectrum of views and objectives meets portfolio construction. And as an asset manager, I think it's important to recognize that just as there's always been a continuum of credit risk tolerances by various clients, there's probably always going to be a spectrum of ESG preferences as well. So day-to-day ESG integration for us in portfolio construction means having to look at ESG analysis alongside the more traditional credit analysis, and then weight position sizes accordingly in accordance with both credit risk tolerances and ESG objectives for individual funds and mandates.
Great, thanks, Thomas. Last but not least, we have with us today Leah Vaisalo, Head of Structuring and Private Credit External Products at Nordea Asset Management. Leah, you're based in Helsinki, where you head the structuring and private credit teams for the external product division of Nordea Asset Management since 2019. Can you tell us how you integrate ESG considerations when it comes to private debt, and how does your process differ for manager commitments versus direct investments?
Thank you, Eileen. Yes, as mentioned, my name is Cecilia Schult, and in the role of as Head of Structuring and Private Credit in Nordea Asset Management, we sit within the investment division and work both with internally managed funds and also our external manager selection. Previously, I've been involved in actually the product development for the sustainable product range in Nordea Bank, and also worked on the life and pension side when we did have the Danish life company some years back. So obviously ESG is something we have really been looking into integrating it throughout the value chain for many years. But currently within the team I run in Nordea Asset Management, we work both with manager selection to our fund of fund program, and then also direct investments in our loans co-investment funds. And of course, we do consider sustainability risks in all the investments we do, whether it being commitments to managers or the co-investments. However, of course, the closer we are to the source and the investment, the more into the detail we can get and the more data we can get. So where the two differ the most is mainly obviously the level of information and the direct impact you can have in setting the terms for the individual loans. So for managers, we perform, we have a general questionnaire, and we always do our own internal ESG rating of the particular manager, just to also benchmark them versus peers. And that's part of an annual review process. But in addition to that, we do obviously a lot of policy reviews and also align as much as possible as we can on guidelines in side letters where possible. So that's of course where we have given the discretion to someone else, and then try to see how much can we actually in practice influence those investment guidelines. For co-investments in the contrary, that's where we basically work very closely on a case-by-case basis with our responsible investment team. So depending on the particular loan or sector, we work with them to define the relevant questions and measures to basically incorporate and integrate in the risk and credit analysis. And there we can obviously be a lot more specific in terms of the type of questions that we ask. So I would say in general, with the standards we have in the market, I would say it's quite hard for a fund of funds or any type of a private asset manager program to possibly be more than an Article 6 in the SFDR if we, at least at the current data standards and reporting. And then of course, where you have the more direct investments, it's much easier to really go in, set the guidelines and be an Article 8 or 9. So that's of course also where we still are rating the final technical standards in great suspense. So I would say that that's overall where it differs. I would say last but not least, of course, within private markets, that's where we can really make a big difference, because then by definition, we are long-term investors. So I think that's of course a final note in that respect that we should really consider in the private debt space.
Excellent. Thanks for all these introductions. And well, I'm just going to jump back directly with you, Leah, and ask you maybe a little bit more details on how you work. What are the requirements for private debt managers that you set in terms of sustainability?
Yeah, good question. I mean, of course, there are also always the hygiene factors. What are their exclusion list, and what is their good governance? So of course, we combine a top-down approach with also the bottom-up in terms of the investment universe. So from top-down, that's where we typically look at, do they have any dedicated ESG resources? How are their policies actually structured? How is their ESG governance, if any? Obviously, quite a few of the managers in question are still quite small. That's easier for us also to influence, obviously, on the co-investment side. Then we also look at ESG reporting to see what we can get in terms of ESG reporting and data collection. And then also a process in place in terms of sanctions, AML, KYC, ESG, to make sure that the worst ESG performers are actually excluded by definition in the investment strategy we choose. Of course, we also want to just verify that within each business case, the manager or a borrower in the case as it may be, are actually integrating ESG in the assessments of the risks for the particular project, corporate or asset, depending on the relevant situation. And that's where we obviously like to see when the two go hand in hand. But again, it's much easier to really do when you have a more hands-on on the deal compared to the managers. But we do try to extend that in terms of then getting engagement reporting and the other restrictions into side letters as mentioned, to make it more concrete where necessary.
Great. And you, Cecilia, how does your process with the managers compare to Leah's? Do you have a different one?
No, I think I can agree with Leah and a lot of the things she already said. It's also a very important point to Scandia. And I think we look for managers that really have both a relevant and a systematic approach, and also have a certain degree of competence within sustainability when we invest. And looking at different requirements, I think we wouldn't lower our minimum standards. It's just that we can adjust our expectations of what the manager actually can do, depending on the type of strategy they're managing. But since data and reporting is not standardized, this also requires a lot of work on our side to evaluate the reports and answers we do get. And then we have to get back with perhaps with more additional questions to clarify and see that we understand each other. And also our different templates and questionnaires, that they're not always perfect fit for private debt strategies. They were developed many years ago for typically public equities. And then we have adjusted them to fit also for private debt strategies, I would say. So it's that's something that's also been developed. But also, I mean, going forward, we will, with these new disclosure regulations, etc., we will have an increased need to understand our managers in terms of, I guess Leah already mentioned, in terms of the different articles, identify and integrate sustainability risks and consider potential adverse sustainability impacts, and to see to what extent and if they include the promotion of environmental or social characteristics. So we need to ask or require more information from our managers. But to this point, there's not a single meeting with managers of private debt strategies now where we don't discuss sustainability or ESG questions. And this is really a massive change for only over the last few years, I would say.
You mentioned the SFDR regulation, and obviously it's been a lot of work for everybody. Perhaps we can hear from Laura how this work has been going on around classifying the funds, and what your concerns have been and how you plan to work on it going forward.
Yeah, I mean, I think SFDR and the regulations and the detail, it's not overly straightforward. I mean, the purpose of them is to increase transparency in the market for investors and minimize greenwashing. And I think it is going to have that impact for the simple reason that the requirements of a portfolio manager and a fund are going to be quite complex. So someone who doesn't have a high ESG conviction, someone who potentially doesn't have the in-house resource or the knowledge as to how to bring their fund up to speed is not going to bother, and they're not going to try and put an ESG or a green tag on something. So that makes the market a little bit more simpler. Investors will be able to kind of see that they're out of the market and focus on those that have a true ESG rationale behind what they're trying to do. We, for example, have our next strategy launching in the next couple of weeks, and we would hope that this fund would be an Article 8 fund. So essentially what that would mean is it's an ESG integrated fund. I think as you go towards 9 and 10, you're looking at more of a thematic and an impact investing and something further down the line. But I think in the first instance, we'll go with Article 8. But within that, and I think we're pretty confident on meeting a lot of the milestones, but there are certain things that are going to be difficult for people playing in the SME market where we operate. Simple things like reporting on scope 1, 2, and 3 emissions of a borrower. I mean, I could be lending to a borrower with a £5 million EBITDA. they're not gathering this information at the moment, and the cost and the resource for them to gather it is going to be quite a lot. So I think there's still quite a lot of work to do on getting everybody up to speed, perhaps getting clarification on, is this for all asset classes? Is it for borrowers of every size? I think there's still a bit more information that needs to come forward with these regulations. And I think it might just be an education process by all parties involved, borrowers, lenders, the regulator, and trying to find a medium that's going to work, because what you don't want to do is exclude those funds merely because they couldn't obtain the data just because it doesn't exist for them. So I think that there's still work to do. It's not as easy as it should be, I think.
Thomas, you look like you're concurring. How have you classified your funds?
Yeah, I would certainly agree with many of the things that Laura's said already. And obviously we worked quite hard to classify all the funds ahead of the 10th of March, the first deadline for doing that. Across our range, particularly within the leveraged finance group of funds, we've classified the majority as Article 6. We have a pretty robust ESG integration process that applies at the issuer level. So for all mandates within that range. And then a couple have been able to go further, and they've tipped into Article 8 as a more of a deliberately sustainable type mandate. That's either through ESG or sector screens, negative screens by sector, all the way through to our next fund launch, which will be in a couple of months' time, a sustainable loan fund that will be going a little bit further than negative screens, in that we'll be taking a more best-in-class approach. So using the scorecards methodology that we have, using external data where it's available from the likes of MSCI. It's not much, it's maybe 10-15% of the larger cap syndicated loan universe, but it's something at least for now as a starting point, and we'll be targeting the very best companies within those methodologies and scoring systems for that fund.
Great, and Julia, you have a fund of funds. How did you work on that one?
Yes, for the SFDR in particular.
Yeah.
Yes, so obviously I would, especially when you also have a legacy, it's of course very difficult to just all of a sudden adapt to new regulation in illiquid assets. So of course we would love for all our funds to be at least an Article 8, as alluded to as well, but it's just not realistic at the moment. Also, I mean, I agree with Laura. We don't want to exclude investments where it's only about the data issue, that we simply cannot invest. So that's why at the moment we're sticking to the Article 6, and then making sure that we have a quite thorough questioning and processes to assess and the ESG safeguards, as we call it. So I think that's really where we are, and then we just need to keep moving the bar up as the transparency increases and data collection improves, and then also that we are really more in line with the standards, and there is more of a commonality in terms of how they should be interpreted. But I would say I'm just quite happy, at least we have the regulation that often gives a push to change, and because before it was a little bit even more of a jungle, and many could attach an SDG to a certain theme or fun, but now we really need to look at the whole full picture, and in terms of impact overall, not only addressing the positives. So I think at least it's a very good development with this regulation. So we're watching it closely.
Excellent. And well, I just follow up with you directly, leaving the SFDR topic behind, but just really moving into the dynamic and the trends in the direct lending market. Do you think the risk return right now is attractive enough? And do you think that ESG has a role to play in that equation, even though some people say that it's a borrower's market.
Yes, I know some people say that. I guess if we take a step back fundamentally, I think I just look at this in a different light. I mean, it was alluded to in the intro, but I think fundamentally we need to believe, are we in a linear economy or are we in a circular economy? We've all been born and bred and raised with the textbooks of the linear economy and addressing the models in the risk returns in that light. And that's where I just strongly believe that when you are looking into private assets and then also private debt in particular, you can really influence a lot. So on one hand, I see this as I see ESG as something that you can integrate into the process to make sure you will reach the long-term goals for the circular economy. And then also on the risk side, I don't see how it can hurt to have more information of a certain investment. So of course, that's what we look into on a case-by-case basis. But fundamentally, you can say, is there a boom towards ESG assets? Of course, we've seen a lot of growth in ESG stocks and securities in general, really increase significantly in price. So of course, it's always hard to say, but we need to dig into the details and see how we're being compensated still from a credit perspective. But having those minimum ESG safeguards in place, that's how I would view it. I believe there are plenty of attractive risk return options in that space.
Cecilia, do you agree with Leah?
Yeah, no, I mean, there's parts of the market that are frothy and we see stretched valuations in some parts, but I certainly agree that there's a lot of areas where we see opportunities in private debt. And to that point, I mean, we would prefer a manager that are accepting a lower return for a lower risk than chasing a specific return target. So, and if you include strong ESG analysis, I think that only helps in evaluating the potential risks of an investment. So, but I mean, since a couple of years back, we actively work to avoid funds that have adverse climate strategies and managers lacking an established and integrated ESG policy. So that's since a long time back. And we see a lot of opportunity for private debt, and we see that the asset class is very relevant in the sustainable investing in general. And as an asset class, I think that it's very suitable for supporting this huge funding gap we have in transition to address the global sustainability challenges, and also to transforming these companies to sustainable companies and sustainable business models, be it circular business models or supporting climate change. So I think there's lots of opportunities and a huge lack of capital. So
there's an opportunities. There's an opportunity to ask you a clarifying question here by Christopher, who seems to know you already quite well, because he's asking to explain your European focus in private debt. What motivates your focus towards Europe rather than having a more global view?
I think that it's just by the comfort of feeling that you have closer to the companies and managers. So it's at least it's a perceived information advantage to be close to the borrowers and managers that you have. And also that we see very strong and good opportunities in these regions, especially the Nordics and Northern European space. So it's a combination of both, I would say. But it's not set in stone that this will not change going forward. But the current allocation is that we prefer Europe.
Excellent. Well, turning to our asset managers. I wanted to know from you guys, maybe Thomas, you can start to tell us a little bit about what you think are the essential qualities for a manager in this market. Given what we have described, there are opportunities, certainly, especially with the ESG view, but on the other hand, again, it might be a borrower's market.
Yeah, there's certainly opportunities and threats, has already been alluded to. I think it's always been the case in this market that size, scale, and very well-established relationships have really been essential in making sure that you see all of the deals that are out there and the opportunities available. And if you see everything, you can be selective. So in the loan space, we typically decline around 60% of the opportunities that we're shown in any given year. And I think when you start overlaying ESG screens of various forms, that in all likelihood will narrow your investable universe to some degree. I think it's also important to be incredibly well resourced. Laura's already alluded to this as well, but proper ESG analysis, integration and engagement takes an awful lot of time. And I've also found, particularly with our newly formed stewardship and sustainability team, where we've got 15 people dedicated just to looking at the thematics and armed with an awful lot of new technology as well, they've been incredibly useful in sitting above the asset classes at M&G. So be that debt, equities, real estate, public or private, they've been able to take the best practice from each market and overlay their own expertise in the thematic topics and leverage the lessons learned, say, in public equity markets. And it's certainly fair to say that they are significantly ahead of private credit. But by leveraging those lessons and those experiences, we've been able to sort of bootstrap our own credit processes and ESG integration processes much faster than we otherwise would have been able to. So size, scale, resource, I think, is absolutely key.
Laura, do you agree with Thomas? And do you have a view particularly on the origination side? What do you think is a very critical component there in order to get access to attractive deal with attractive ESG profiles?
Yeah, I mean, I agree with Thomas. Origination is key. And I mean, that was something that when we were setting up all of our funds was just a key attribute that we wanted to have involved. So we actually have quite a unique setup. We have 4 legally binding origination agreements with partner banks in our core geographies. So in the Nordics, in Germany, in the Benelux and in the UK, which means that every time our partner bank originates a deal, they have to introduce it to us at exactly the same time. And we get first refusal as to whether we participate and continue to, say, attend the management presentations, obtain the DD, submit a term sheet, go through the full process, or if we want to step away. And that means that we're seeing between 400 and 500 deals a year. And we operate quite a low risk strategy, which means we have quite a diversified portfolio. So we're looking to select about 5 to 10% of those deals max. So we have the ability to walk away. And it depends on your ESG conviction. For an example, and I think an example might explain why it's so important, why a manager who is forced to deploy, who's not originating enough deals, might just have a way of overlooking certain things that they shouldn't related to ESG, because maybe they're not a core massive risk that's been highlighted, but really they shouldn't be proceeding. So we had a deal introduced to us. It was a debt collection business. So they were collecting fines, say, that had been unpaid council taxes, high court fines, things like that. So initially our concern was around, well, how were the debt collectors remunerated? Because we had concerns that if they were paid based on how much they collected, this could be incentivizing aggressive techniques. And all of a sudden we were going to see Federated's name in the papers over some sort of incident or things like that. So we discussed with management. We even considered incorporating characteristics into the loan documentation to amend how the remuneration would be. So we were going to be able to get comfortable. But something that appeared in the financial due diligence, which was a red flag for us, was there had been £1.5 million of overpaid fines. And they used to sit in a ring-fenced account where the company couldn't touch them. But last year, the company had made the decision to transfer that money into the company cash account. So this kind of raised concerns as to, well, how do you try and return the fines? Why did you decide to do that? And what did your auditor say? And the comment that came back was, well, the auditor said, don't do it again. So it wasn't a qualified opinion in the financial accounts. It wasn't something that they had been fined or brought up on, but it was something that just rang an alarm bell on governance. That if management were willing to do this, I mean, are there other things that they have done or would be willing to do? And we were just not comfortable with that. And it was great cash flow, really great relationships, good margin. We were going to get paid well. It had all the characteristics of a deal we liked, but that one governance alarm bell rang and we just had to walk away from it quite late in the process. And that is because we know we can decline that, and with all the deals we're seeing, we're going to get a call that afternoon or tomorrow morning with another one and continue. Whereas someone who's not originating enough might just say, maybe we can get comfortable, it was a one-off and management said it was okay and the auditor didn't flag it. And then you're kind of taking your investors with you into potentially risky assets. And that's not a place investors want to be. So origination is key. And I think the other one is knowledge, knowledge within your team and within your firm. So knowing the right questions to ask, because you have to remember we're operating in a liquid market. Once you make that loan, it's actually quite difficult to get out. So you need to upfront a lot of your analysis. So what questions are you going to ask of a borrower in all these different industries and all these really niche industries, sub-industries that you're looking at. But not only that, what answers are you expecting to get back? What is a benchmark? What's standard? What should you be expecting? What are you going to do if an ESG issue arises? Do you have engagement experience in your team? For example, at Federated Hermes, we have a team of 55 engagers. And putting that in perspective, we have 120 investment staff. So it's 2 to 1. This is something we take incredibly seriously, so we can rely on the resources and the knowledge of that engagement team to come up with a plan for us, give us the right questions, give us the knowledge, and come along and engage with borrowers to try and remedy an issue if one is to arise. So knowledge is key. Smaller funds, those that don't have the in-house capability, are going to struggle. I think investors just need to ask the questions and make sure that their managers are well resourced.
And you mentioned that in this example that you were thinking about putting something into the documentation, and an interesting trend that has started to accelerate since the beginning of this year is the introduction in the documentation of ESG related targets. What's your view about that, and how do you wish this will progress? Like, maybe I just ask it as a follow-up to you, Laura, and then Thomas can comment as well.
Yeah, I mean, I think there's 2 approaches that you can take, put simply, like a carrot and a stick approach. So carrot being the ESG margin ratchets. I would say I'm a bit of a cynic on the ratchets at the moment. I think if you're offering a 5 to 10 basis point improvement for a borrower to improve some ESG characteristic, it's not enough. 1, it's optional. They don't have to do it. Putting it in perspective, if you have a 50 million EBITDA borrower, 5 to 10% is 50,000. How are they incentivized? They're not really. And also, how do you know that the borrower wasn't going to do that anyway? So I think there's a touch of, you need to be careful that the manager isn't greenwashing a little bit here by overinflating what they're achieving in terms of improving on ESG characteristics. But the stick approach that you can take, and the one that I would prefer, is agreeing with management upfront and incorporating your requirements, your enhancements into the loan documentation on day 1, where there is a time frame for them to achieve it, that everything is measurable, everything is very descriptive. And if they don't meet it, it's a default. And that might sound incredibly harsh, but on day 1, you have management's buy-in and you have the owner's buy-in, and everyone's agreed, and they are very incentivized to get these things done because no one wants to declare a default. And it's not about making it so harsh because we're trying to take the keys. It's about making sure that things get done, and they get done in the right frame of right time frame, because at the end of the day, we're trying to enhance the EV to ensure that our investors are more protected. We had one recently, I won't go into too much detail given who the audience might be, but we had a Swedish road markings business. The company was making an acquisition, and the company that they were acquiring, the ESG standards and the health and safety, amongst other things, were just not up to scratch compared to the underlying business. So we agreed with management a number of things that they needed to achieve in the first 6 months. And all of that was detailed in the loan documentation. Small things from health and safety training for your employees through to how they were transporting dangerous goods because of the chemicals and things like that. So it is achievable, and they had 6 months to do it, otherwise it would have been a default, and they got it all done. And then you know that you've enhanced the EV, your investors are more protected, and nicely there's environmental improvements with all of that as well. So I think there's 2 ways of doing it. I'm certainly in the loan undertakings camp for now, unless people are going to start offering more meaningful ratchets.
Thomas, do you agree with Laura, or do you have a slightly different preference about ratchets?
I think I agree with many of the things that Laura has said already, and speaking for perhaps the larger cap, more syndicated loan world, ESG margin ratchets have become something of a market standard for new issuance so far this year, I would say. So we've seen anything between plus and minus 5 to 15 basis points based on the achievement or not of between 2 and 4 KPIs. And it's those KPIs that have become something of a real personal bugbear for me as well. And I think my colleagues and the banks that I speak to are probably quite tired of hearing my complaints about it now. But as a market, it's certainly fair to say in the large cap world, we're in the early days of defining what those practical standards and mechanisms are. And we're continuing to work with the likes of the Loan Market Association, LMA, ELFA, and the LSTA to really set and agree the acceptable expectations around those ratchets. So far this year, we have actually seen some quite good ESG KPIs, particularly around scope 1 and 2 emissions, D&I metrics, or linking to more comprehensive third-party reviews such as S&P evaluation scores. And I think whilst I agree it's not much, it's only 5 to 15 basis points as an opportunity, or also a cost if you don't meet those KPIs. So it's a bit bigger if you include the full range of outcomes. I think it does, one, deliver some information in some cases, encourage disclosure, but it also brings the issues to the forefront of management's minds and thinking to help bring some of the pertinent issues up the agenda. I think what we need to really see now to make sure that more systematically the KPIs are acting in the best interests of everyone and ultimately the environment. They need to be clearly stated at the outset of processes, not brought in at the last minute just because they can be, because the deal's going well. They should be appropriate for the nature of the business, and they should be stretching. So we've seen goals or attempts to introduce things as weak as, or just appoint a sustainability officer to the board, or introducing a KPI that has perhaps already been met or is very close to being met. So I think if we overcome some of those issues and really set good standards that the market agrees to, then at the margins, I think they're a positive incentive and certainly a good, as we're finding today, they're a good talking point and they're useful for bringing the issues to the forefront of mind.
Turning to Cecilia, do you think that data, the availability of data for private debt has improved over the past few years? Because obviously data is really important for measurements in this context.
Yeah, absolutely. The awareness of the importance of integrating ESG aspects and promoting these sustainability aspects and sustainable business models in all asset classes, as many as mentioned before, it has really exploded, and I really can see the change since I started in 2013. And this includes not the least how we systematically integrate ESG analysis, both from a bottom-up perspective, obviously, when we invest in companies, but also in evaluating ESG at the external fund manager level. And this includes, of course, the private debt strategies. But it can be in terms of understanding the ESG resources at an organizational level and how ESG is incorporated in the philosophy of a strategy, and how ESG is integrated in the process and the portfolio construction. And what, not the least, as said before as well, to have the right resources, both internally at an organization level, but also at the team level, and really that the PM of a specific strategy also integrates these aspects and are comfortable in discussing and talking about these aspects. So to that point, we also, when we invest in funds, we are very close with the managers, and we always review portfolio holdings from an ESG perspective to validate that the manager, his process is really shown also in the holdings. And I know that, I mean, only a couple of years back when we discussed with managers of private debt funds, they really hesitated to sign up for on UNPRI, for example, due to both not seeing the benefits of doing so, and also because they thought that reporting didn't do them justice. And here we see a very clear change. And today we don't have any managers of private debt strategies that haven't signed UNPRI. And I know there's also been a lot of work done at the PRI, and in 2019 they published a paper that aims to promote better understanding of the rationale for responsible investing and in private debt context. But I mean, I think Leah also said that in her introduction, but to give some examples of Skandia, how we work to get more information is that, I mean, we do send out a responsible investment questionnaire every time we potentially will invest with the private debt managers. And if we invest, it will be sent annually, and they will get a score, an ESG score between 1 and 4, where 4 is the best, and 1 we wouldn't probably invest, but it's evaluated at the one point in time, and then we see a trend if there's improvements, and we typically expect improvements to be seen. And we always have at least one annual ESG focus review meeting with our managers where a member of our ESG team is present to have a really deep ESG discussion, both in terms of what they have chosen to invest in, but also what they have decided not to invest in based on ESG factors. And we also include ESG language in the legal docs for each investment. And this is standard, I would say, since at least 5 years back. But it differs, the content and if it's included depends on the strategy, but we always have an ESG language to secure a minimum level, I would say, of ESG integration in the strategies. So a lot has been done, both from a manager side in providing information, but also from our side in systematically asking for this information.
Thanks, and I'll follow up with Leah and ask Julia how important you think, I mean, how important data standardization is to you and how it has progressed. But I will also read to you a question from one of the attendees, because it's directly related to the topic. And it's actually directed specifically to you. So okay. Alberto says, we have seen that ESG disclosure has been easier for large cap companies than small cap, as they can dedicate more resource. Also for managers, it will be easier for larger staff firms to dedicate resources and report on ESG. And this does not necessarily reflect the manager's conviction around dedication to sustainability, and even less so their ability to generate performance. But how do you prevent that how do you avoid having a selection bias?
In terms of ESG, non-ESG?
Yeah, I guess that's the question.
I guess we're just not non-ESG. I mean, that's really the minimum bar that we have to adhere to. And I do see also from smaller managers, maybe it is more usual in the Nordics, because we've always had more of a recycling and sustainable culture, I guess, in our region, that even smaller managers do have at least half a person dedicated, or one person to develop ESG and sustainability. We also see it from some sponsors actually hiring even technical engineers to try and improve energy efficiency or other type of thing, dedicated resources for that. Again, if you believe in the circular economy and you believe in the long-term benefits, I think it's also worth for the business to invest in that, whether large or small. But of course, there will, as we heard from the large asset managers, of course, it's somehow easier. But we look at actually, I mean, a lot of the data also for the deals. So of course, in the top-down approach, it's always more of a bragging factor if you can say, I have 50 analysts and governance people dedicated to that. But that doesn't necessarily mean that it's actually integrated in the investment decision. So we have seen a lot of managers, also large, where we have simply said, sorry, we can't invest in the past, because it didn't mean that it was actually integrated and and the responsible investment team didn't have any influence on the PM decision at the end of the day. Obviously, this is maybe more a little bit applicable to liquid markets, but the same concept can be applied here. Is ESG part of the investment process? You can also see it in the type of deals done in the past and deals executed. So we really do try to also collect for every investment we do the data of past deals done, and not only for the particular fund if we're coming in a half part of the build-up, but also for earlier funds, to see what has actually been the deployment of capital to what type of business cases in practice. So I of course, maybe on the face of it, but not if you dig in the details. I think then it shouldn't really matter too much.
And staying on this topic of the constraints that you're asking your managers to adhere to, you have some exclusions, some blanket exclusions over certain sectors, or that obviously comes sometimes into conflict with the idea of engagement. And we have actually also a question from the audience from Altaf who says, how do you look at managers who say we don't have blanket exclusions but prefer to use engagement to try and create change at portfolio companies or borrowers? Do you want to pick this up, Leah, and then maybe Cecilia, if you want to add something?
Yeah, I can, but again, I mean, there are some industries that we just do not believe in our organization. So in terms of fossil fuels, we have to have a clear business strategy towards Paris Agreement to even look at it. For our private investments, typically it's completely out of scope within that sector, also production, etc. Nuclear weapons, tobacco, you know, some of the standard norms as well. So of course we do run a very extensive sector minimum exclusion, and even I mean, for those sectors, unless it's a very specific case where we can see a specific use of proceeds for a transitional project that is ring fenced, I do not see how we could invest in that. So of course, a case like in Denmark, we've seen Ørsted, great transitional company, but it's also been issuing green bonds also with dedicated purpose. And unless we would see that, I don't see that in a manager and a strategy, I don't see how we would be able to invest in sectors that would be sensitive from an ESG point of view. So that's simply just a stance. And we believe there are some business models and areas that are simply beyond repair and that we are not looking to finance. Yeah, so that's, you know, as you can tell, a complete no-go. I would also say that I mean, obviously already now we touched the data points. In financial data, they're not even standards. So EBITDA adjustments, etc. We really need to really understand the risk return of a certain manager. We do need to dig into the details to see how, you know, what type of deals we're actually doing. So we prefer very much this type of use of proceeds earmarking approach, where we have the transparency and can monitor it, compared to the more the very, you know, unstrict guidelines, because otherwise there's no way for us to really keep the minimum level in check.
And you, Cecilia, do you have the same kind of approach? Maybe you want to add something about?
Yeah, no. I think I would agree. I mean, we have certain sectors where it's a no-go for us to invest. But that said, we are very keen on being able to support the transition to sustainable business models and so forth. But that would still have to be in companies where we really believe that change is possible. And for certain sectors, we don't see that being the case. So there it's a no-go. But we do engage both with directly with companies and certainly with managers of private debt funds to help them develop their ESG work and to trying to transform the business models to sustainable ones. So that's an active engagement we do.
Laura, you said earlier that engagement is an important part of your work, and I'm conscious of time. So maybe if you want to touch upon that with a couple of words, and then also tell us How do you think that how do you think the key is to avoid greenwashing in the direct lending and private debt investment universe?
Sure. I mean, I think engagement is key, and it can happen at a number of points throughout the life of a loan. I think engaging up front, as I mentioned, a liquid loan. So you want to engage and make sure that management are incentivized to put through the improvements that you're going to need in order to feel that you've got the right risk reward profile. Engagement can also happen, and I think it's more prevalent in possibly the geographies we target, which are Northern Europe. I think there's more of a sustainability focus. Also in the mid-market, you're typically providing your financing in a club of two to three lenders. So you're engaging with management, you have their email addresses, you have their phone numbers, you have a good relationship with them. So it's very easy to pick up and communicate with them about, have you guys considered this? Are you thinking about this? And also being able to rely on our in-house engagement team and our responsibility office of, we have this type of borrower, what sort of trends are you seeing? What should they be thinking of? What can they be incorporated? We can bring those experts into the meetings just to get borrowers comfortable about how a plan might look in practice to do it, that we can help them with that. So that would be kind of on the engagement side. And I think in terms of greenwashing, how do you avoid it? Or how do you make sure you're not investing with somebody who is potentially greenwashing? I think it's just asking all the questions. It's doing your DD, as Leigh and Cecilia have alluded to. What investments have they done? What have they not done? Getting concrete examples. Which ones have they incorporated? Ratchets or loan undertakings? How do they report on their ESG to investors? What are investors going to be provided on a quarterly basis? What stats? What in-house resource do they have? I would be looking as well at the wider picture. What is the conviction of the entire firm? Is this one standalone fund that they've decided, okay, let's ride the wave of impact here and make an impact fund, but is there buy-in from the whole firm as a whole? And so will staff continue to be educated? Will there be cross collaboration across different products? All of this, it's ongoing education. It's an evolving industry, and you need to make sure that the people that are providing the loans are going to continue to be educated and learn and continue to apply all the knowledge and resource that's available in the market. So I think it's just ask the questions and ask for examples.
Excellent. Thomas, do you have a final word on how to avoid greenwashing?
Yeah, transparency and collaboration, absolutely key between asset managers and asset owners. I think nobody has all the answers day one, certainly not in private credit. And that's fine, that's okay, as long as there's a discussion to work together on a plan to set the targets, and so everyone understands quite clearly where you'd like to get to and by when. But greenwashing and claiming to do more than you really are is just not a sustainable asset management strategy. I think in the same way, opportunistic ratchets go against the fundamental principles of what we're discussing here in the ESG approach. So too does greenwashing at the fund level.
Cecilia, a final word of wisdom on greenwashing?
No, I think we're all alluded to do it, and we really look for how fund managers work with sustainability. What ambitions do they have, and what targets do they have, and it's really important that the whole firm stands behind these values, and they have a public policy on ESG standpoints, etc. And what type of resources do they have, and how do they work with engagement? That's really important to us as well. And then I think the really important idea here is to fully understand what the portfolio manager actually has invested in and what they have not invested in. I think that's really important. And as Thomas said, transparency and collaboration. I mean, we have lots of discussions with our managers to understand their view and to give them our view. And I think that sharing information and sharing knowledge is really important.
Excellent. And Leah, you have the last word here. Do you have any special
word.
wishes?
Very
any
quickly
special wishes?
Yeah, I mean, of course, as it was alluded to, very much the ex ante focus, not exposed. Oh, sorry, you didn't meet the target. But and then also, of course, increased transparency and more work on developing the notion of use of proceeds. So it becomes more than just the investor's problem, but also the actual borrower's problem.
Wow, this hour has really passed really quickly, at least for me. I hope that everyone enjoyed the discussion as much as I did. And but thank you so much for today. Thank you for your time, and hope to see you soon again.